Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to depreciation and cash flow statement. Get ready, because it's time to take a stance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side. We're going to be putting together a partial income statement and then a partial cash flow statement. Our major comparison here between A and B is going to be with the effect of the depreciation. Depreciation differing from A and B. What will be the effect on the income statement of that difference? What will be the effect when we think about cash flow, which will then feed into what we'll have to do on a cash flow statement basis. All right, so let's put this together. We're going to put together the income statement. We're going to start with gross profit. And this is going to be equal to the 890,000. So if you're visualizing the income statement, we started with revenue, you can imagine, then cost of goods sold, and then we would have gross profit. So we're starting at gross profit basically after the cost of goods sold. Revenue minus cost of goods sold gives us gross profit, and then we're going to move on down to basically net income or earnings after taxes as normal. So next I'm going to pick up the selling and admin. So we're going to pick up the selling and admin. I'm going to say this is going to be equal to the 125. I'm going to do the same thing for B here. So for B, this is going to be equal to the gross profit of 890 as well. Selling and admin has the same 125. And then the differentiation factor here, it's going to be equal to the, let's just say depreciation expense is going to be equal to, for A, this 370,000. And then for B, it's going to be equal to the 65,000. Let's put a difference column in here. So let's say the difference, and then what I'm going to do, and this should be there already for you, but I'm going to highlight this whole column. I'm going to go to the Home tab, Paintbrush, hit the Format Painter, and I'm going to format this one the same way. It's formatting it the same way. So if we subtract this, I'm going to say this will be equal to then the 890 minus the 890. So it's going to be the same. And then I'm going to copy that down. I'm going to use the autofill. So I'm going to put my cursor on autofill. I'm going to copy all that down, all the way down. So we'll see the difference in all columns. Obviously, this is where the focus will be on the depreciation. So that's where our difference is. I'm going to go ahead and underline these two. Home tab, font, underline. And then that's going to give us our operating profit. So we'll pick up the operating profit then, which will be equal to, we're going to say up, the 890 minus up twice, the 125 minus up once, the 370. That's going to be the 395. Now let's see it for B, which will be a bit different. We got up, the 890 minus up, 125 minus up 1, the 65. That gives us the 700. So the operating profit, of course, is reflecting the difference with regards to the depreciation. Now, remember what the depreciation is. It's going to be something that's on the books, and we'll talk more about calculating depreciation later, but it's an accrual concept, meaning when we buy something large, like a building or something like that, we don't just expense it even if we paid cash for it, because even though that would be what we would do on a cash basis, it's a very big distortion of performance over time. If we make just giant expense for a building we purchase now, when really it's going to be benefiting us many years into the future. Therefore, what we do is we put it on the books as an asset, and then we apply the depreciation expense over time. So that means that the depreciation expense, when we apply the depreciation expense, is not when the cash went out. Therefore, it's an accrual thing. And so it shouldn't be there when we think about cash flow. So if we think about the operating profit, then it makes sense to include depreciation because it helps us to measure performance over time. If we were not to do that, then we would have a very big distortion comparing the year that we bought the building if we paid cash for it, and the following year where we didn't buy the building, but where we are using the building. So it wouldn't be a fair comparison of our performance over time to have one huge expense in the first year and no expense in the second year. That's why we do the accrual basis for it. However, on a cash flow basis, that would make sense, and we would want to know that. So that's the difference between these two, we'll call them companies, or these two scenarios. is that there's a lot more depreciation expense in A, meaning they must have a lot more buildings and whatnot, or newer stuff and equipment, depreciable assets, larger depreciation. B has less. So even though their gross income and their selling and admin is the same, the operating profit for A is a lot less, and for B, it's going to be a lot more due to that depreciation expense, which doesn't involve cash. And then we're going to be picking up the taxes. So taxes is 40% of our operating profit. So I'm going to be picking up, this is going to be equal to the 395 times 40%, pointing to the 40%. So E5 times B11, that's going to be the 158. And remember that this 40%, you might say, hey, how do you get that taxable income? It shouldn't be based on book profit. And remember that when we consider the estimate that we're going to be making, we will try to figure a tax rate which will take into consideration all the factors that will need to be taken into consideration so that we can apply a tax rate to the book profit. So that 40% then, in other words, is not necessarily the tax rate that is on taxable income on the tax return, because we had to figure out how to apply it to book income. So just keep that in mind. I used to see these problems and say that there's something wrong that's too simplified, and it used to kind of bug me. But it's not the case here. But it's just that this tax rate isn't the same tax rate that you will have necessarily on the tax return. We'll have to figure out an appropriate rate for this estimate. So in any case, we're going to say this is going to be the 700,000 times the 40%. So F5 times B11. So that's going to be the 280,000. Then we will get to the earnings after taxes, or the net income. Obviously, there's a tax effect here that's being impacted based on the depreciation as well, because the depreciation, you would think, would lower the taxable income and whatnot. So then we're going to then do the subtraction. This is going to be equal to 395 minus the tax. So E5 minus E6, we'll copy this over here as well. This will be F5 minus F6. Let's put an underline under the tax line. So I'm going to select these lines. I'm going to go up to the Home tab font group, put an underline there. Let's put a double underline under the bottom line number here to emphasize it. Home tab font group, drop down, double underline. So there we have that. And again, you can see these differences that we have. So the net income at the end of the day is different due to, of course, the depreciation. So now let's think about a cash flow system, because these are not items on a cash flow basis. If I was to reconstruct this income statement on a cash flow basis, we would have to remove the depreciation. So you can think about this, a couple different ways. I could say on an indirect kind of basis, if I want to think about the cash flow, then I can start with this earnings after taxes. And we could say, okay, I'm going to pick up the earnings after taxes here and here. And we could add the same difference column. So let's add the difference column as well. And I'm going to highlight, these will be there for you already. Home tab, clipboard. I'm going to make these, we'll have the difference. This will be equal to the 237 minus the 420. So there's our difference, same as we had up top. And then we're going to pick up the depreciation expense. The depreciation expense, which is going to be this 370, and the 65. I'm going to add this back up, equals the sum. I'm sorry, I'm going to subtract this out. Equals the 370 minus the 65. And now we're going to add that back in. This is an indirect method. It was taken out of the income down here. We're going to basically add it back in at this point. So this is going to be this plus the 370, or the 607. We'll do the same thing here. It's going to be this plus this, and then we have our difference is going to be this and this, and this will be the cash flow. So that's the cash flow. And so that would be, let's underline this. I'm going to select these, Home tab font. Let's put an underline there, and then let's select the bottom ones and go to the Home tab font drop down, and let's put a double underline there. So you can see that's kind of an indirect type of method for us to reverse out the cash flow. So we took the ending balance here, we reversed back out the cash. So this would be then the flow on if it was a cash flow method. Now there's still a difference. Why is there still a difference? Because we calculated the taxes. The depreciation will have an impact on the taxes. So that's going to be, so if the taxes were actually paid, we'll still have a difference due to the depreciation causing us a difference in the amount of taxes that would actually be paid, even though we're reversing out the difference due to the depreciation. Now, you can also do this you can also think about this in terms of what if we reconstructed this on a direct method. Like if I copy this back out, this will already be there for you. So I'll copy this back out and say, okay, what if we did this on a direct method and I reconstructed the income statement and just didn't take into consideration those items which were not accrual basis, including in this case, just the depreciation. So if I said, all right, we've got, this is the same, and this is going to be the same, and the difference between, there's no difference, this equals this minus this, no difference there. We got the admin is going to be this, and that's going to be the same. No difference here is going to be this minus this. And there we have, and then I'm not going to include depreciation because because I'm on a cash basis now. So this is the income statement on a cash basis. And then we'll have the operating profit, which is going to be this equal this minus this, and equals this minus this. And then we'll subtract this out. So hold on a second here. I picked up the wrong number here. Like, this should be the same. This minus the 125. Then we have the same numbers going down. Now the tax is going to be different. I'm going to pick up the tax from the calculation we did up here, which is taking into consideration the depreciation effect on the taxes. So we'll still have that difference up top due to the taxes. And then if we were to take the after-tax effect, it's the 765 minus the taxes, 765 minus the taxes, and then we could say this minus this, and that's going to be our difference. So we come up to our same numbers down below, this being basically a direct method, this being kind of an indirect method, considering the one account that we're kind of focusing in on that's not an accrual type of account, which is going to be the depreciation. Now, when you think about the depreciation, we'll get into this later on the indirect method. There is an effect on the balance sheet every time we have this kind of accrual issue. What's the effect on the balance sheet? We could think of that out. We can think about, in other words, this depreciation expense as a change on the balance sheet, a change that would be included in accumulated depreciation. So that's another convenient way to look at it, because that's going to be one way that we'll back into a lot of our indirect method accrual accounts when we do the cash flow statement, which is kind of confusing because you're kind of focusing in on these income statement accounts because they're timing accounts mostly. You're looking at the income statement accounts, but you're doing so by looking at the balance sheet and changes in the balance sheet accounts, because you're looking at changes that are a result of accrual concepts that will reverse out onto the income statement. So in other words, you could look at the balance sheet, look at the change in accumulated depreciation to figure out this difference, which would be depreciation expense, which would be on the income statement, in order to back out from a cash flow statement on an indirect method the effect of that depreciation expense on net income. In other words, adding it back in to the net income to get cash flows from, in essence, operations.